Hello, welcome again. So this is the chapter 8, part 1. So in this chapter, we will discuss about the inventories, the measurement of inventory. Okay, so let's think about inventory. What is inventory? Okay, so the first one, let me tell you something about the iPhone, the production of iPhone. In 2017, Apple produced total 217,722,000 iPhone. That's a huge, correct? But they have sold 216,757,000 iPhones. So that remaining iPhones, so the total 966,000 is their inventory in 2017. So this is the unsold number of iPhones. So this is the inventory. So what is inventory? Inventory is the unsold iPhone, correct? The unsold iPhone that has not been sold, okay? So inventory means that the company intends to sell in the normal course of business and has in production for future sale or uses currently in production of goods to be sold. So this one is a little bit different. See, this one it is saying uses, meaning the inventory is used currently in the production of goods to be sold. It means that the raw materials inventory, okay? So cost of goods sold is the expense related to inventory. Okay, we'll discuss about it. So there are two types of companies, merchandising and manufacturing companies. So in case of merchandising, so what the merchandisers do, they usually purchase and sell. Okay, say they have purchased 100 units, okay, and they have sold 90 units. So the remaining 10 units are their inventory. And in case of manufacturing, think about the Apple. So if they have produced 100 units and they have sold 20 units, so the remaining 80 units should be their inventory. Okay, so in case of goods that are purchased primarily in finished form from wholesalers and retailers, correct? So the cost of merchandise inventory includes purchase price plus any additional costs that is required to get goods in the condition and location for sale. And in case of manufacturing company, so the goods are produced by manufacturing company to be sold to wholesalers, retailers, and other manufacturers. Okay, now, so in case of manufacturing companies, there are three kinds of inventories. So the raw materials, work in process, and finished goods. So the raw materials, as you know, that represents the cost of components purchased from suppliers that will become part of the finished products. For example, computer chips in case of computer. Work in process refers to the products that are not yet complete. The cost of work in process include the cost of raw materials, the cost of labor that can be directly traced, and manufacturing overhead. And the finished goods, cost of goods that have been completed in the manufacturing process but have not been sold. Okay. So this is an example of Intel Corporation's inventory disclosures. So the companies generally disclose either in a note or directly in the balance sheet the dollar amount of each inventory category. So in case of Intel Corporation, so we can see the raw materials, work in process, and finished goods. There are total inventory, and these are the components of total inventories. Okay. So the raw materials, direct labors, manufacturing overhead, they are grouping together, they work together, and they become work in process, and finally they are the finished goods. And the cost of the goods is called cost of goods sold. And there are two types of inventory system. The first one is the perpetual inventory system, and the second one is the periodic inventory system. most of the companies right now, especially the retailers, they use the perpetual inventory system. For example, in case of Walmart, uh, in case of the Macy's, all of them are using the perpetual inventory system. So it continually adjusts the inventory account for each change in inventory caused by a purchase, sale, or return of inventory. And it continually adjusts the cost of goods sold account each time goods are sold, returned by a customer. So it allows management to determine goods on hand on any date, determine the number of items sold during a period. Okay, let's have an example. So when we go to the Walmart, okay, and every time we scan the barcode of a product or an item, so three things happen. The first one, it subtracts the inventory, okay, so the total inventory goes down. And number two, it adds cost to the cost of goods sold, and it adds revenues from in the sales revenue. Okay, three things happen every time. So after every single barcode scan. And here is an example. So in this example, the company begins 2021 with an inventory of 120,000 on hand. The following information relates to the inventory transactions during 2021. The additional soft drink inventory is purchased on account at the cost of 600,000, and sales for the year was 820,000, and the cost of the sold goods was 540,000. So they use the perpetual inventory system, and let's see how they record. The first one is to record the purchase, inventory, and accounts payable, and to record the sales. So they have sold 820,000 and they sold on credit. So that is why accounts receivable debit and sales revenue credit. And for the cost of goods sold, so the cost of goods sold is 540,000 and inventory is 540,000. And the periodic inventory system, it adjusts the inventory account and records cost of goods sold only at the end of each reporting period. Okay, so if you report say monthly, so after every month you will count the inventory physically. Okay, so after every single month you will be counting the inventory. So this is done under the periodic inventory system. Okay, so cost of goods sold in this case would be beginning inventory plus net purchase minus any inventory. Okay, so the periodic inventory system with the following previous example, so it's the same example. So the additional soft drink inventory is purchased on account at a cost of 600,000 and sold 820,000, and let's see how record. So the purchase account debit and accounts payable credit to record the purchase of inventory on account. Okay, and when we are selling, accounts receivable debit and sales revenue credit. So no entry is recorded for the cost of inventory sold. But we recorded cost of inventory under the perpetual inventory system, because every time we are selling under the perpetual inventory system, it automatically gives us the cost of goods sold and number of inventory. See that? So that is why we are recording two journal entries after every single sale under perpetual inventory system. So the cost of goods sold, see that the company begins the year with 120,000, then additional soft drink purchase 600,000, total sales 820,000. Physical count determine the cost of the inventory at the end of the year to 180,000. So the beginning inventory 120, at purchase, so go cost of goods available for sale 720, and minus any inventory per physical count is 180,000. So finally cost of goods sold is gonna be 540,000. See that? So the cost of goods sold, as we have done earlier. So how do we record cost of goods sold? Debit, inventory, any inventory, debit. So inventory, beginning inventory 120,000 and purchase 600,000. Okay. So this one, no, let's go to some other things. Okay, now physical units included in inventory. So which physical units should be included in the inventory count? Okay, so items in the possession of the company, goods that are in transit, goods on consignment, and anticipated sales returns. Okay, so goods in transit refers to situations where the goods are on the way to their destination, meaning the goods are in between the suppliers and the buyer. See that? So the accounting for goods in transit depends on ownership of the goods. So this is really important. Who is the owner of the goods that are in between the buyer and the seller? Okay, so as you can see from here, free on board shipping point, this is the term. Okay, on this term, see, here is the seller and here is the buyer. So the ownership, meaning the title, is transferred at this point. Okay, meaning as soon as the ship leaves the seller's dock, so the ownership goes to the buyer. So the goods that are in transit should be owned by the buyer. Okay, and in case of free on board destinations, see that, so the ownership is transferred, meaning the title is transferred to the buyer as soon as the goods arrive the buyer's destination. Okay, here at this point. Okay, let's have another example. So here is the seller, here is the buyer. So this is the free on board destination. So in this case, free on board destination, so the these are the goods in transit. Okay, these are the goods in transit. So the ownership of these goods goes to the seller in case of destination. See that? And in case of free on board shipping point, the ownership goes to the buyer. Okay, so these goods are owned by the buyer in case of free on board shipping point. Okay, so these are the examples. Okay, and in case of goods on consignment, so here is the person who is the consignor, means, say for example, here is Apple. Okay, here is Apple. Okay, they send, say, 100 units of, not say 1,000 units of iPhone to, this is, say, TNT. Okay, TNT is not buying the 1,000 units of iPhone. They are just keeping those 1,000 iPhones in their warehouse, okay, for sale. So the ownership of these iPhones, okay, is the, meaning is Apple. Okay, the ownership goes to the Apple. So the consignee is not the owner of the goods sent on consignment. Okay, so in more detail we can see that, see, here is the consignor, here is the consignee. Okay, so the consignor who sends goods on consignment to another person. Okay, so the unsold inventories left with the consignee, okay, will be counted as inventory of the consignor. Okay, so have that in mind. So in case of, so just remember these things. In case of physical counting of the inventory, in case of goods in transit, free on board shipping point, the ownership goes to the buyer, and free on board destination, ownership goes to the seller. And in case of goods held on consignment, the ownership goes to the consignor. You got it? So now we will be solving some problems on these discussions. So welcome to the second part. So thank you.